Did Japan really break the US stock market? On Monday, August 5th, the Nikkei, Japan's main stock market index, took a nosedive, dropping 12% and causing the US Dow Jones Industrial Average to plummet over 1,000 points. But the drama did not stop there. On Tuesday, the Nikkei actually bounced back, surging 10% and triggering market circuit breakers in Japan that basically halted trading for a while in the process. YouTube exploded with videos claiming that Japan had crashed the stock market. Today, I'm diving into whether those claims are true, how Japan's wild market swings affect the US and the global financial markets, predictions for the Bank of Japan's response, the Federal Reserve's response, and most importantly, how you as a trader can navigate trading in these hyper-volatile times. But first, don't forget to like, subscribe, and hit that notifications button if you don't want to miss another valuable update. Now, let's get right into it. In many ways, I do agree that Japan's stock market shook up the US and the global markets. It didn't just make waves, it shattered any remaining positive sentiment in the financial world. If the Nikkei had not plummeted 12% in one single day, which was the worst drop in over 36 years, the Dow probably wouldn't have tanked 1,000 points on Monday. But when US traders woke up and they saw the shocking news of Japan's market tanking or taking its worst hit since Black Monday in 1987, panic spread like wildfire through the financial markets. Typically, it's the US markets that sets the tone for the rest of the world. But if you are a student of history or you're old enough to remember the 1997 Asian financial crisis, you'll know firsthand how the markets in Asia can also shake things up globally. The Asian contagion is very real. Now, you could definitely argue that a weak U.S. jobs report triggered the sharp sell-off in the U.S. dollar, which boosted the Japanese yen and toppled Japan's market. But let's be real. Japan has its own set of problems, and this recovery is flimsy at best. If the market hadn't taken a nosedive, the fear and panic might not have spread so quickly. Even though the markets bounced back on Tuesday, fear and panic doesn't just disappear overnight. I think all of you are aware of that, especially without some catalyst, like a promise or even a hint of fiscal or monetary support, say an emergency interest rate cut, for example, from the Federal Reserve. One big reason why I do believe that Japan broke the US stock market is that it also sent the VIX, which is Wall Street's fear gauge, skyrocketing to its highest level since the pandemic. And while it did drop from 65 down to 25, as you can see in this chart, shaking off the fear that has set in as a result will not be easy. The meltdown in the markets and the spike in volatility has huge implications for the financial markets because it accelerates any plans for easing by central banks. Take the Federal Reserve, for example. They are now expected to cut interest rates by 50 basis points in September. And, with the possibility of an emergency intermediate cut in August. I mean, just imagine that. A month ago, no one was even sure whether or not the Federal Reserve was going to lower interest rates in September. It was like a 50-50 chance. Now, other central banks like the European Central Bank, the Bank of England, the Bank of Canada could also ease more aggressively and more extensively than what we had previously anticipated. On the flip side, any chance of another near-term interest rate hike by the Bank of Japan this fall is gone out of the window. The 14% surge in the Japanese yen since its July low has essentially wiped out most of the stimulus that the weak currency provides the economy this year. Just imagine as a tourist, now going to Japan has been 14% more expensive. And it's that, basically reduces the attractiveness of it. When you combine that with the recent Bank of Japan interest rate hike and the outlook for Japan's economy, as a result, it looks very different. Economic data, including household spending numbers, hasn't been great already. And without continued economic growth due to a weak currency, those numbers could soften even further. So what does all this mean for you as a trader or an investor? How can you make better trade selections? First off, the crash in Japan's market has blown up the daily trading ranges for equity indices as well as currencies. Those 100 to 200 pip range days in dollar yen and other yen pairs are now 200 to 500 pips, if not more. So set your stops accordingly. If you have a strong view and you want to take a positional trade, go for a smaller position size with a wider stop because you're going to need it. Here's what I've been doing. I have been watching the market like a hawk when I do my zip day trades. I always set an emergency stop of 30 to 40 pips because, with my zip trades, I'm either right or not in that moment. It's a momentum trade. And I get in and out quickly, taking out my profits when I can. Check out this perfect example of my trades on Monday evening and Tuesday after the big moves. Now, I never trade on Mondays, but that's a whole other discussion about knowing when to trade and when not to trade. So if you look at my zip day trades, which is in this zip channel for our members, BK Trader members, on Monday evening at the Asia Open, which is when I trade the Asia Open and the New York Open, we came out and we sold dollar yen at 145.88. Small position right against the zip indicator line, and the markets moved quickly. It hit our short target very, very quickly on this trade. And I went back in, and because it was showing weakness, I sold it at 145.71, and that also, did not take long to hit target. Pretty much, by 8:40 p.m., which was another 10 minutes later, it ended up hitting target. Now, on this day, I also put on a swing trade, and that swing trade initially it was a 1-unit trade. And then I added another unit. We sold at 93. We sold again at 75. And we have an average price of 145.84. Now, the reason why, and you'll notice this is at 8:30 a.m. The reason why I put on both of these trades is because I felt like, dollar yen was going to move lower, but there was an opportunity that needed more of a wider breathing room. 40 pip stop instead of the smaller stop that I had on the day trades. And this one, and it did. So not only did my targets on the day trades hit, but the swing trade moved quickly. The first target hit with break even, then I trailed my stop 30, within 20 minutes to 145.15, and we ended up closing the entire trade for 119 pips. Then at the start of the New York session on Tuesday, I had a bunch of other trades that I put on, trying to probe what was going on in the markets. There was a lot of volatility in the yen crosses. I stayed out of it at the onset. Most of these trades, except for EuroCAD, closed at break even. EuroCAD, I actually closed for a profit. But the point I want to make is that the real trading opportunity, it took a little time for it to figure itself out, but the real trading opportunity was also in the yen crosses. I sold Euro Yen at 158.43, and shortly thereafter, the target was hit. I went back in, sold it again at 158.18, target hit again, and then I also put on a swing trade. Now, because the moves were already overextended, it wasn't like the Asia session trades where we were trading a retrace. The moves were already overextended, and so what I did was I decided to just lay on half a position. So we laid on half a position. We had 3 zip sell signals, 1, 2, 3, and we sold Euro Yen. Target plus 40 was hit quickly. I went back in. Because that zip sell signal was still very valid, and it was still early in the trading session. I thought there could be more momentum. Put that trade in, and it did end up hitting target anyway, but I closed it for plus 32, and so in 12 hours we made 164 pips in the swing trades, and more than 80 pips in the day trades. Second, despite the recovery, I still think it's better to look for opportunities to sell rather than buy stock indices, dollar yen, carry trades, or other yen pairs. Unless policymakers pledge support to the economy, they come out from left field and say this, or for the market, the factors that have spooked the market in the first place, like weak U.S. data, the growing chance of a 50 basis point September Federal Reserve interest rate cut, and the consequences that a strong Japanese yen has on Japan's economy, hasn't changed. In fact, the outlook has worsened. Third, keep an eye on the Federal Reserve and U.S. data. As critical as Japan's market moves and the Bank of Japan may be, the next leg in the U.S. markets and the forex market in general will be determined by what the Federal Reserve does or doesn't do. Several Federal Reserve presidents will be speaking in the coming weeks, and so you need to listen very closely to what they say. If they cast doubt on a 50 basis point interest rate cut or an emergency rate cut, it could end up helping to reverse the slide in the US dollar. However, if they say nothing and they stay silent, it could actually signal further losses for the greenback. Now, I hope you found these tips valuable, and these tips will hopefully help you navigate the increasingly volatile markets. If you want to get my zip indicator and trade ideas, check out the links in the description below. If you enjoyed this video, once again, don't forget to like, subscribe, and hit the notifications bell so you never miss an update.